The Federal Reserve signaling some concern yesterday about market turbulence and slow economic growth overseas. It did not rule out another gradual rate increase in March, but very few people are believing it. I want to bring in the Wall Street Journal's chief economics correspondent, John Hilsenrath, and Ameriprise financial chief market strategist here in the studio, David Joy. Gentlemen, good to see you.
Morning.
Thank you so much for joining us. John, first, kick us off. What did you learn from the Fed yesterday?
Well, I learned that they're very worried about how the economy is doing and how it's going to be affected in particular by overseas developments and market turbulence. You know, they came out of their December rate increase expressing confidence about the outlook for employment and inflation. And this time they say they're not sure if it's going to be time to revise their forecast down in March. So they're in a wait-and-see mode. But it looks like they could be in a pause mode, too.
Is that what you heard, David?
Yeah, it is. John mentioned an interesting word, confidence. Confidence is very important to the Fed, and so they don't want to backtrack on their position from just a few weeks ago, but they did leave themselves an option to basically go on pause and get a little bit closer to where the market is. The market has not been on the same page.
Look, I realize not everybody predicted the macro story in 2015, but how did the Fed miss this? I mean, there were a fair amount of people saying we could go into recession in 2016. Things are slowing down. Oil prices, and there are always knock-on effects of oil. How is it possible that all of a sudden now they're saying that the economy slowed down? I mean, you think?
Yeah. I mean, we did have signs at the end of last year. I think in defense of the Fed, I'm going to say they didn't totally mess this up because they acted on the notion that the economy has improved so much because we have this cumulative body of evidence that it's time to raise rates. But they've always said they're going to be data dependent. What we've always said is until there is going to be more economic momentum, we're not going to see a whole lot more rate increases out of the Fed. And we're not seeing that momentum right now.
I was just going to say, this is a central bank they missed their opportunity to raise interest rates and raise them up to 1% or 1.5%. I mean, they're 2 years behind the curve on this. They were so scared to do anything for so long, they've allowed this to just elongate. Now they're in a really difficult position.
There is one additional aspect, I think, to this.
Comment, John.
And that is that the Fed is looking at the economy, and we have a tendency to look at the markets. Now, one influences the other, but if you think about what the Fed's responsibility is, the U.S. economy is actually doing okay. Certainly, we're impacted by the weakness overseas and in oil. But the labor markets had been quite strong going into year-end, not so much on the inflation front, but otherwise, if you think about what their responsibility is, I think they were justified in doing what they did.
John?
I want to make 2 points. One relates to your question, Maria. How did the Fed miss this?
Yeah.
I'll tell you what they missed and what a lot of people missed, and that's China. You know, when I've talked to Fed officials over the years about the booms in China, the real estate boom and the industrial capacity boom, they had this sense that Chinese officials were very effective at managing that economy, almost more effective than anyone else in the world. That their growth was that they had magically engineered this 10% growth and it was going to go on for a long time.
Right.
I think they overestimated the ability of the Chinese to manage that economy and for the economy to sustain itself. That was a big miss. But it wasn't just them, it was everybody. This other point that the Fed missed an opportunity to raise rates, frankly, I just don't get that. You know, if the Fed had raised rates up to 1%, where would we be right now? The economy's barely growing, and rates are under 0.5%.
Really?
You know, if the Fed had moved rates up to 1%, you know, would the housing market be coming back at this point?
Yeah, but John,
would consumer spending on autos be as high as they are?
We've gone through 4 rounds of quantitative easing, and every time we're getting less bang for the buck. So the Fed knows it's not working anymore.
But why does that mean that rates should be a full percentage point higher than they are right now? The economy can barely manage 0.5%. Why would it be able to manage 1%? I just don't get that.
It's in a stronger position 2 years ago than it is right now. And we're no longer in an emergency lending situation. You should be at zero interest rates. And now the Fed's in a position where they can't do anything.
So are you defending all the QE? John, is that what you're doing? You're defending the QE?
I didn't say anything about QE, and I'm not defending anybody. What I'm saying is I don't get the argument that rates should be a full percentage point higher than they are now when the economy can barely grow and inflation is below 2% with them near zero.
You're right, John, you're right. Now,
I just don't get that.
2 years ago, this economy could have
it was
easily
so
handled
weak and inflation was so low that they felt they had to do more. If you know, if they were raising rates 2 years ago, we could be in deflation
so
right
wait,
now.
are you saying that the Fed didn't miss anything?
Oh, the Fed has missed a lot, but I don't see how, if an economy can barely grow right now with rates near zero, why would we be expecting it to be doing so much better with rates at 1%? It just doesn't add up to me.
No, but I don't think that anyone's making that argument, John. No one's making that argument at all.
The Fed has to be really, really cautious here, and the reality is that the momentum in the fourth quarter has definitely slowed. So if the Fed is cautious, maybe the markets need to be cautious too. So, David, any thoughts on the near-term or long-term reaction of the markets to this?
Well, I think the market will probably like what the Fed did yesterday to the extent that it takes some pressure off the dollar. The dollar's been driving oil prices lower. It's been driving currencies, particularly in the emerging world, lower, and that's been deflationary. So if what they said yesterday takes a little bit of pressure off of that, maybe we can find some stability in the markets. If the markets don't respond, however, the dollar doesn't respond in a sustainable way, then I'm afraid this market is on shaky ground, and maybe the next move is still lower.
So what do you want to tell clients then? You want to just be in cash?
Well, for the near term, I think you want to be a little bit cautious. If you have cash, I'd be very slow to put it back to work. Certainly some values are beginning to emerge, but if you're a longer-term investor and you have a well-diversified portfolio, stay the course. I think the U.S. economy is going to be just fine.
Do you agree with that, Anastasia? What are you telling clients?
You know, I think it's definitely a more challenging environment. Strategic allocation is the most important decision you will ever make, but I do think there's opportunity to be more tactical now. Certainly you want to select the companies with strength, and there's probably nothing wrong with maybe trading the ranges a little bit. You know, there's nothing wrong with having a rally and taking some money off the table and maybe deploying that sometime further down the road. The point is, you don't want to do this with 100% of your portfolio. You want to do this with a smaller portion of your portfolio. That's how you add that alpha.
All right, John, real quick, are you expecting a move in March, or no? Is that off the table at this point?
Well, you know, I think we have to see this. We say it all the time, but I think we have to see what the numbers look like. I'll tell you what, if the jobless rate keeps coming down, if we've got like a 4.7% handle on the jobless rate, then yeah, I think they do have to keep moving because, you know, they respond to slack in the economy, and that means there's less slack.
Oh, my God. They're going to get so criticized if they move and raise interest rates in March, I think.
Yeah.
I don't know.
No, I agree.
I don't know. I
probably get criticized either way, right?
Yeah.
We'll see. John Hilsenrath, always a pleasure. Thank you, sir.
All right,
David
thanks a lot.
Joy, good to see you. Thank you so much for joining us.